There's a chart that defies the laws of physics. It defies the laws of economics. And if you look closely at it, it defies the laws of sanity. It is the stock price of Nvidia. In just 3 years, this company did not just grow, it exploded. It went from a valuation of under $400 billion to over $4 trillion. To put that into perspective, Nvidia added the entire value of the French economy to its market cap in less time than it takes to build a single factory. They call it the AI gold rush. They tell you that we are standing on the precipice of a new industrial revolution. They tell you that Jensen Huang is the new prophet and that his chips are the oil of the 21st century. But there's a very specific rule in financial history. When a line on a graph goes vertical, it doesn't end in a plateau, it ends in a crime scene. We are witnessing the greatest accumulation of capital in one asset in human history. Every pension fund, every 401k, every retail investor, and every algorithm is crowded into this one trade. The entire global economy is currently balancing on the shoulders of a single chip maker in Santa Clara. But what if the foundation is fake? What if the gold rush is just a circular money laundering scheme disguised as innovation? What if the billions of dollars in revenue aren't coming from real customers, but from a circular financing loop that is mathematically guaranteed to break? There is a man who sees the crash coming. Michael Burry, the man who famously shorted the 2008 housing market when everyone else was celebrating, has placed his bet. He sees the ghost of the year 2000. He sees the ghost of Cisco. And he believes that when Nvidia breaks, it won't just take down the tech sector. It will trigger a margin call that rips through the entire global financial system. This isn't a story about computer chips. This is a story about the biggest financial bubble ever blown and the needle that is already touching the skin. Part 1. The shovel seller's paradox. To understand the trap, we first have to understand the narrative. The story Wall Street tells you is simple. During a gold rush, don't dig for gold, sell the shovels. In this story, AI is the gold. Companies like OpenAI, Microsoft, and Google are the miners. And Nvidia? Nvidia owns the only shovel factory on Earth. Their GPUs, the H100s, the Blackwells, are the engines that make artificial intelligence possible. Demand is so high that tech CEOs are reportedly begging Jensen Huang for allocation. They are shipping chips as fast as they can make them, with profit margins that would make a drug cartel jealous. 75% gross margins on hardware. That is unheard of in the history of electronics. It sounds perfect. It sounds like a monopoly printing press. But there is a fatal flaw in the sell the shovels strategy. It only works as long as the miners are finding gold. If the miners dig and dig, spending billions of dollars on shovels, but all they find is dirt, eventually they stop buying shovels. And when they stop buying, the shovel seller doesn't just slow down, he goes bankrupt because he built massive factories anticipating a rush that has suddenly ended. This brings us to the return on investment problem, the ROI gap. Right now, the tech industry is spending roughly $1 trillion on AI infrastructure. They are building data centers the size of small cities. They are buying Nvidia chips by the boatload. But what is the return? Where's the profit? Sequoia Capital, one of the most respected VC firms in the world, crunched the numbers. They found a $600 billion hole. The industry is spending hundreds of billions on chips, but generative AI products like ChatGPT, Gemini, and Copilot are only generating a fraction of that in revenue. 95% of AI projects today are burning cash. They are cool demos. They write funny poems. They generate weird images, but they are not profitable businesses. We are seeing a massive disconnect between capital expenditure, buying the chips, and revenue, using the chips. The entire valuation of Nvidia is based on the assumption that this spending will continue forever. But economics dictates that if an investment doesn't make money, the investment stops. And when the spending stops, the Nvidia chart doesn't just correct, it collapses. Part 2, the ghost of Cisco 2000. History doesn't repeat itself, but it rhymes. And if you listen closely to the rhythm of Nvidia today, it sounds exactly like the rhythm of Cisco systems in March of 2000. Back then, the buzzword wasn't AI, it was the internet. Cisco was the company that made the routers and switches. They were the plumbing of the internet. They were selling the shovels. Wall Street said that the internet would change everything, and they were right. They said that every company on Earth would need Cisco hardware, and they were right. Because of this narrative, Cisco became the most valuable company in the world. Its stock went parabolic. Investors said, it doesn't matter what price you pay, just buy Cisco. But then, the capacity glut happened. Companies had panic bought so much Cisco equipment that they had more than they needed. They had built infrastructure for traffic that hadn't arrived yet. Suddenly, orders evaporated. The backlog vanished. In 12 months, Cisco stock fell 80%. It wiped out $400 billion in shareholder value. Even though the internet did change the world, and even though Cisco survived, the investors who bought the top never recovered their money. It took 20 years for the stock price to get even close to its 2000 peak. Michael Burry looks at Nvidia and sees Cisco. We are seeing the exact same panic buying. Mark Zuckerberg is buying 350,000 H100 GPUs, not because he has a profitable use for them right now, but because he is terrified of falling behind. It is fear of missing out disguised as corporate strategy. This creates a double bubble. First, you have the bubble in the stock price. Second, you have the bubble in the physical inventory. When these companies realize they have overbuilt, that they have millions of chips sitting idle, consuming electricity for no profit, the orders will go to zero overnight. Part 3, the circular funding scheme, the Ponzi dynamic. But the ROI problem and the Cisco parallel are just the surface. If you dig deeper into Nvidia's financials, you find something much darker. You find a structure that looks suspiciously like circular financing. This is the mechanism that keeps the bubble inflating. Here is how it works. Nvidia makes massive profits. They have billions in cash. They take that cash and invest it in AI cloud startups, companies like CoreWeave or other sovereign AI clouds. Then those startups take that investment money and use it to buy chips from Nvidia. Do you see the loop? Nvidia gives money to a company. That company gives the money back to Nvidia and records it as revenue. Nvidia then reports record revenue growth to Wall Street. The stock price goes up. Nvidia makes more money. They invest in more startups. The startups buy more chips. It is a perpetual motion machine of valuation. In the old days, we called this round tripping. It was one of the key tricks used by Enron. It creates the illusion of organic demand, when in reality, the company is essentially funding its own customers. Why is this dangerous? Because these startups, these customers, are not businesses. They are vessels for debt. They are borrowing billions of dollars against the chips they just bought, using the chips as collateral to buy more chips. It is a house of cards built on silicon. If the value of the chips drops because of oversupply or competition, the collateral is worthless. The loans default, the startups go bankrupt. And Nvidia's revenue stream, which looked so robust, vanishes into thin air. Wall Street analysts are conveniently ignoring this. They are looking at the top line number and cheering. But they are not looking at who is writing the checks. A significant portion of Nvidia's explosion in revenue is coming from entities that Nvidia itself has financially supported or that are backed by the same venture capitalists who are desperate to pump the ecosystem. It is a closed loop, and closed loops always break. Part 4, the financial engineering off-balance sheet horror. But the deception goes beyond circular funding. We are seeing financial engineering on a scale that rivals the 2008 housing crisis. Look at the biggest customers, Meta, Microsoft, Amazon. They are all desperate to show Wall Street that they are winning the AI war. But they also need to protect their own profit margins. Buying billions of dollars of chips hurts the balance sheet. So what do? They use off-balance sheet maneuvers. They sign leases. They use shell companies. They partner with cloud providers like CoreWeave. Microsoft, for example, agreed to spend billions with CoreWeave over several years. CoreWeave then takes that contract to a bank, like Blackstone or Magnetar, and gets a massive loan to buy Nvidia chips. Microsoft doesn't have the debt on its books. Microsoft just has a service expense. Nvidia gets the sale instantly. The bank gets the interest. And the risk? The risk is buried in a private company, CoreWeave, that nobody is looking at closely. This is exactly what happened in 2008 with shadow banking. Banks moved risky mortgages off their books into special purpose vehicles so they looked healthy. But the risk didn't disappear. It just went into the shadows. We are building a massive mountain of debt to fund these data centers. These are $100 billion projects. The energy requirements alone are bankrupting local grids. If the AI hype cycle cools down, even by 10%, the cash flow required to service this shadow debt stops. And just like in 2008, when the subprime borrowers stopped paying, the whole chain reacted. If the AI startups default on their GPU loans, the shadow lenders take a hit. If the shadow lenders take a hit, credit tightens. If credit tightens, the big tech giants stop spending. The leverage in this system is terrifying because it is opaque. We don't know how much debt is actually supporting the $4 trillion valuation. We just know that everyone is borrowing from everyone else to buy the same product. Part 5. The monopoly breaks. The Google threat. Every bubble needs a narrative of invincibility. For Nvidia, the narrative is they have no competition. Their moat is uncrossable. For a while, this was true. CUDA, Nvidia's software platform, locked developers in. It was the only game in town. But capitalism hates a monopoly, especially a monopoly with 75% margins. Those margins are a signal to every other company on Earth. Come kill us. And the killers are here. The biggest threat to Nvidia isn't AMD or Intel. It is Nvidia's own best customers. Google, Amazon, and Microsoft have realized that they cannot afford to pay the Nvidia tax forever. If they want to scale AI to billions of users, they cannot pay $30,000 per chip. So they are building their own. Google has been quietly developing TPUs, tensor processing units, for years. And now they are ready for prime time. Google's latest Gemini models, some of the most powerful AI in the world, were not trained on Nvidia chips. They were trained entirely on Google's own hardware. This is the crack in the dam. Amazon has Trainium and Inferentia. Microsoft has Maya. Apple is using its own silicon. As these massive tech giants shift their workloads to their own custom chips, Nvidia's demand cliff will be vertical. They will go from being the only supplier to being the expensive supplier of last resort. The market is pricing Nvidia as if it will have 90% market share forever. But in hardware history, no one keeps 90% market share. Not Intel, not Cisco, not IBM. The moment the monopoly breaks, the valuation multiple collapses. Nvidia is priced for perfection. But the reality is that their biggest customers are actively plotting their assassination. Part 6. The Magnificent 7 Domino Effect. Now, you might be thinking, okay, so Nvidia stock crashes. I don't own Nvidia, so I'm safe. This is the most dangerous illusion of all, that you do own Nvidia. If you have a pension, if you have an index fund, if you have a savings account managed by a bank, you own Nvidia. The US stock market has become dangerously concentrated. The Magnificent 7, Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla, make up nearly 30–40% of the entire value of the S&P 500. This is not a diversified market. It is a crowded theater with one exit. Nvidia is the linchpin. It is the engine driving the growth of the other 6. Microsoft's stock is up because of AI. Meta is up because of AI. If you remove the AI premium, the entire stock market looks flat or negative for the last 2 years. This is what we call correlation risk. If Nvidia misses earnings, if they come out and say demand is slowing, it won't just be Nvidia that falls. The algorithms will instantly sell Microsoft. They will sell Google. They will sell the entire NASDAQ. Because these companies are financially entangled. Microsoft has invested billions in the infrastructure that buys Nvidia chips. If Nvidia fails, it means the infrastructure is worthless, which means Microsoft's balance sheet is impaired. It is a daisy chain of failure. In 2008, the contagion spread from housing to banks to the rest of the world. In 2026, the contagion will spread from Nvidia to big tech to the global economy. And the timing couldn't be worse. The US economy is already fragile. Interest rates are high. The consumer is tapped out. The commercial real estate market is collapsing. The only thing holding up the illusion of a strong economy is the stock market wealth effect driven by AI. If you pop the AI bubble, you remove the last pillar supporting the US economy. Part 7. The psychology of the bag holder. Why doesn't anyone stop it? Why do the analysts keep raising their price targets? Why does CNBC keep cheering? Because they are paid to. Wall Street makes money on volume. They make money on IPOs. They make money on fees. They need the bubble. They need you to buy at the top so they can sell. We saw this in 1999. Analysts were putting $1,000 price targets on stocks that were bankrupt 6 months later. We saw this in 2008. Ratings agencies were giving A-to-A ratings to garbage mortgage bonds days before they imploded. They are doing it again. They are rationalizing the irrational. They are inventing new metrics like price to innovation to justify valuations that make no mathematical sense. It is the psychology of the greater fool theory. Everyone knows it's a bubble, but everyone thinks they can get out before it pops. They think they are smarter than the market. But Michael Burry knows the truth. When the exit door opens, it is never wide enough for everyone. When the sentiment shifts, and it always shifts overnight, the liquidity vanishes. There will be no buyers at $120. There will be no buyers at $100. The drop will be an air pocket. Conclusion: the financial supernova. Nvidia is not a company anymore. It is a financial supernova. It is burning brighter than anything else in the galaxy, sucking in all the capital, all the attention, and all the hope of the global economy. But supernovas always end the same way. They run out of fuel, they collapse under their own gravity, and then they explode. The fuel for Nvidia is the shovel-selling narrative. That fuel is running low. The ROI isn't there. The customers are building their own shovels. And the financing is circular. When this star collapses, it will create a black hole that consumes trillions of dollars of wealth. It won't just be a bad day for tech bros in Silicon Valley. It will be a pension crisis. It will be a liquidity crisis. It could be the trigger for a recession that makes 2008 look like a warm-up. The warning signs are flashing neon red. The insider selling, the circular funding, the historical parallels. But just like in Rome, just like in 2000 and just like in 2008, the music is playing so loud that nobody wants to hear the fire alarm. The shovel seller has become the master of the world, but he is standing on a mountain of dirt. The gold mine is empty. Are you holding the bag, or are you watching from a distance? Because when this breaks, nobody is safe from the fallout.